Peter Lynch is one of the most successful and well-known investors of all time. Lynch is the legendary former manager of the Magellan Fund at the major investment brokerage Fidelity. He took over the fund in 1977 at age 33 and ran it for 13 years. During his time at the Magellan Fund, investors earned an annualized return of 29.2%. An investor who put $1,000 into the fund the day Lynch took over would have had $28,000 the day he left. His investment style has always been to diversify and focus on fundamentals instead of focusing on what the market is saying. Lynch always stressed that you should be able to understand what you own. His book, One Up on Wall Street, was first published in 1988 in the aftermath of the Black Monday crash of October 19, 1987. This was a time when institutional investors were really making a lot of noise on Wall Street, and the small investor had lost faith in his own abilities. In this book, Peter Lynch tries to tell investors that in fact, the reality couldn't be more different from the truth. Big investors are faced with several restrictions that make it very difficult for them to make money, and actually the smaller investor should trust in their own abilities rather than hand over their funds to institutions. On this week's edition of Filter Coffee Finance, we will dissect One Up on Wall Street for you and give you all of the most important takeaways from this book. Buckle in guys, we are getting right into it. Smart money isn't that smart and dumb money isn't that dumb. When it comes to stock market, Peter Lynch says that there are two types of investors: smart money investors like big mutual funds and hedge funds, and dumb money investors like you and I. Now, even though the names do sound a little insulting, don't take it personally. Lynch tells us that the reality of the game is that smart money isn't that smart and dumb money really isn't all that dumb. Smart money investors such as mutual funds pretend like they're doing a lot of work. However, the sad reality is that they are playing things safe. When given the choice between taking a risk on investing in an unknown company and making a large profit, or making a small loss on a popular company such as TCS, smart money will choose the latter. As Peter Lynch likes to say, you'll never lose your job if you lose your client's money on IBM. Wall Street investors are servants of the stock market. Mutual funds are structured in such a way that analysts get a lot of money to invest when all stocks are extremely expensive and are forced to sell great companies when markets crashing. This will always mean that big investors will buy stocks when prices are high and sell stocks when prices crash. Another big handicap for smart money is that their entire performance is judged on the short term. Analysts in these funds have to focus on keeping their investors happy over the next 12 months. Past investment performance is by no chance an indication of future outperformance. When looking at such funds, no one will stop and think about the survivorship bias that might be playing out. For every mutual fund that has returned 45% in the last 6 months, there will be dozens of funds that have lost 25% in the past 6 months. Dumb money investors, on the other hand, have several advantages that could see them do better than Wall Street investors in the long term. For one, you and I have the advantage of being experts in a particular field and knowing what products we like. Look around your house today. Some of the best stocks to invest in can be found on the shelves of your kitchen and even on the walls of your house. Sometimes the best companies to invest in enter your house even before a Wall Street firm begins coverage of the product. Retail investors also might know best about which companies to invest in because of the specialized knowledge they have of a product. Say you have spent 10 years working in the automobile industry. Chances are that you will know which auto companies are run best and which auto companies are lagging. Even before the quarterly results are out, dumb money knows what to do. Look for companies that have not been certified by Wall Street. Wall Street only knows about a company once it has gone from 50 rupees to 500 rupees. If you hear of a tip from smart money, you've got it too late. What are the different categories of stocks? According to Peter Lynch, there are 6 different types of companies for an investor to choose from. Number 1, slow growers. These are large and mature companies operating in well-consolidated industries. There aren't too many of these companies in Lynch's portfolio. This is because if the earnings are growing slowly, the stock price isn't likely to be going anywhere. Number 2, stalwarts. These are household names such as Coca-Cola and Colgate-Palmolive. Stalwarts have the reputation of being faster and more agile than slow growers, and hence investors can expect a 10 to 12% per year growth rate in earnings. Fast growers, they are among Peter Lynch's favorite companies. These businesses generate a 20% growth rate in earnings year on year. The reason that they can do this is that they are small, aggressive, and an up and coming industry. It is in this group of companies that the next 100 baggers can be found. Number 4. Cyclicals. These are companies whose revenues rise and fall with the economic cycle. When times are good, these companies make a lot of money. However, cyclical will suffer when the economy goes the other way. Timing is key for these businesses. Number 5. Turnarounds. These are companies that have survived an industry decline or have lost their reputation due to a scandal. In fact, these companies may already be bankrupt. They are potential fatalities. However, if they can find the solution to their problems, they can make a strong return. Number 6. Asset plays. Situations where the market undervalues the assets of a company create asset plays. The asset can be simple like a pile of cash, and sometimes it can be real estate. If the market begins to undervalue a company, there can be massive opportunities for the investor. Companies don't stay in the same category forever. Fast growers can lead exciting lives and then suddenly burn out. Sooner rather than later, what makes them special fades away and they become stalwarts and slow growers. You will know if a stock can become a 10 bagger by correctly identifying which category it comes under. The traits possessed by the next multi-bagger. The company name is dull or even better ridiculous. To make his point, Peter Lynch talks about a company called Pep Boys, Manny Mo Jack. Lynch says that no analyst in his right mind will take such a company seriously unless Wall Street realizes how profitable it is. The second attribute is that the company does something dull. Lynch says that he loves to find a company with a boring name that also does something boring. A company with a boring name that works in a boring industry is the best way to keep all the oxymorons out. The company does something disagreeable. Some of the best opportunities out there in the market today involve companies that come under a regulatory grey area. A company operating in a grey area has the potential to be the next 100 bagger, but it also has the potential to be worthless. Spin-off. Spin-offs happen when large parent companies break up into smaller, separate independent businesses. Spin-off failures bring back bad publicity to the parent company, which is why the parent wants them to be successful. Therefore, spin-offs normally tend to have strong balance sheets and can compete with the market very well. Number 5. Negative rumors about the company. And number 6. There is something depressing about the business. What can be more depressing than death? Service Corp International has been operating in the funeral industry since the 1960s, and in that time, it has grown to become an employer of 21,000 people and generates $4 billion in revenue each year. Back in the 80s, this company was shunned by Wall Street. Smart money missed the perfect opportunity. There was rapid growth, earnings are compounding, there was no debt, and there was progress for all to see. Company in a no-growth industry. For every product in a hot industry, there are 1,000 graduates working day and night trying to figure out how to make it cheaper and better. This doesn't happen with bottle caps or funerals. In a boring and upsetting no-growth industry, there is no competition. This gives the good companies in this industry the space to grow and build market share. Companies with a niche. To explain, Peter Lynch says that he wants to own the only rock pit in town. He says that even though this might seem boring, owning the only rock pit in town gives him a monopoly. Even the rock pit from the neighboring town won't be able to enter his market because the cost of transport will be huge. Some of the other important traits that Peter Lynch says that can help us identify the next multi-bagger are as follows. Do people need to keep buying the product? Company is a user of technology. Insiders buying. Company is buying back shares. Institutions don't own it, analysts don't follow it. Once you've identified the next possible multi-bagger, it is important to know what phase the company is in. Phase 1. This is the riskiest phase for the investor. The company creates a new product or is innovative in reaching new markets. If they are successful, then the stock will be able to enter into the next phase. Tech startups like Amazon, right after the dot-com bubble burst, are one of the best examples of a phase 1 company. Phase 2 is the profitability phase of the company cycle. At this point, the company has a working business model and is replicating that model around you. If an investor can identify when a company has moved from phase 1 to phase 2 before Wall Street, the possibilities are truly endless. Companies like Bajaj Finance and Page Industries in the years 2011-2012 are prime examples of companies that transitioned into phase 2 of the company life cycle. Phase 3. This is the maturity phase of a company. Once a business has secured the entire market, where can it go? The only way that a brand like Dunkin' Donuts can grow is if they win over McDonald's customers. Companies need to face their limitations at this point and will have to either innovate or perish. To think of an example of a phase 3 business, we just need to think of the Coca-Cola company. The final checklist. So finally, now that we've almost come to the end of the book, here are a few important takeaways. Check the PE ratio for every stock you consider. Is it high or low for the industry it is operating in? Along with this, it is also important to check and see if the earnings are sporadic or consistent. Does the company pay dividends regularly? This is especially important for slow growers. Dividends should grow at around the same pace as the growth in earnings. Consider the size of a company if you expect it to profit from a single product. For example, Pampers is a very fast-growing product sold by Procter & Gamble. Sales of diapers have done very well for the parent company. Does this mean that after looking at Pampers, we should invest in P&G? Look for small companies that are already successful and are proving that their concept can be successful in other industries. It is also important to see who is interested in holding the company that you are considering. Look into the percentage of institutional ownership. The lower, the better. Are insiders buying shares or is the company announcing buybacks? Both are positive signs. Avoid hot stock and hot industries. Invest in simple companies that appear dull. And lastly, it is always important to check and see where the company is spending its money. Distrust diversifications. A company will only talk about diversification if the management is unable to innovate in the industry that it is already operating in. Lynch says that there is no such thing as diversification, only diversifications. Does the company have a lot of debt on its books? What is the debt to equity ratio? For cyclicals, keep tabs on inventories. Take advantage of the valuable skill sets you create in your jobs. They might not reach the professionals for months. Conclusion. And with that, we come to the end of this summary of One Up on Wall Street. Let's take a quick glance at the key points in this book. Smart money isn't really all that smart, and dumb money isn't all that dumb. There are 6 different kinds of stocks available in the market. The first step to picking the next multibagger is to identify which category a stock belongs to. If you find out about a stock from Wall Street, the chances are that you will be buying it at a very expensive price. Original thinking and real-world experience are your biggest advantages over the institutional investor. Once you find a stock that could be the next big thing, check and see which phase of the company cycle it is in. Innovative companies always tend to belong to phase 2. Just like that, we've covered another incredible book on investing here at Filter Coffee Finance. We really hope that you enjoyed this edition. If you did, please do like and share. It's a small step that goes a long way in helping us make useful personal financial videos for all of you. If you like the content you found here, check out our other videos on investing and finance as well. If there is any specific topic out there that you would like to see in the future, please do let us know. As always, we are open to any tips and suggestions that you might have in mind. Keep smiling, and until we meet again, this is Filter Coffee Finance signing off.